A credit score is not a judgment of who you are. It's a single variable measurement of one thing: how predictably you've repaid debt. That's it. That's the whole algorithm. But lenders, landlords, insurance companies, even some employers, they use that number to make decisions that shape your entire financial life. The interest rate on your mortgage, whether you get the apartment, what you pay every month to insure your car, every tier of this score has a different version of reality. We're starting at the floor. Your score is 410. Maybe you know exactly how it got here. Maybe you don't. A hospital bill from 2 years ago, a phone contract that went sideways, or just nothing. No credit history at all, and the absence of data reads as risk. Here's what 410 means on a Tuesday afternoon when you need a place to live. You find a one-bedroom listing for $700 a month. You call, you tour it, you like it, you apply. The landlord runs your credit and doesn't call back for 2 days. When he does, he says the unit just got taken. It didn't. You check the listing an hour later. Still up. The next landlord is honest. He'll rent to you, but he wants first month, last month, and a $750 security deposit. You hand over $2,150 before you own a single night's sleep there. You need a car to get to work. The dealership that will finance you puts you in a 5-year-old sedan with 94,000 miles on it. The rate is 23.8% APR. Over 60 months, you'll pay $9,840 in interest. Not for the car, for the loan. The car costs less than the interest you paid to buy it. Your cell carrier won't approve a device plan. You walk out with a prepaid phone and $260 less in your pocket. Your car insurance renews? Your insurer pulls your credit as part of the process, legal in most states. Your premium rises $52 a month. You didn't have an accident. You didn't change your coverage. Your score moved and the bill followed. Rent is short 1 month. You look up a payday lender, $350 borrowed. 2 weeks later, you owe $413. That's a 390% annualized interest rate, and it's perfectly legal. At $300 to $499, the system doesn't ignore you. It charges you a premium for existing inside it every month, every renewal, every application. Here's the part they don't put in financial literacy class: the expensive decisions people make at low credit scores. The payday loans, the buy here, pay here lots, the prepaid phones aren't always the result of bad thinking. Sometimes they're the only options available. The system prices you out of the good choices first, then charges you more for the ones that remain. That's not an excuse to stay here. It's a reason to understand why leaving matters so much. Your score is 547. You've been paying on time for 8 months. One collection account came off your report. Something shifted. Barely, but it shifted. You open a secured card, you put down $250 of your own money. Your credit limit is $250. You're essentially lending yourself money with a middleman. But the account reports to the bureaus, and that's the point. You get approved for a store card. $400 limit, 27.99% APR, $69 annual fee. You take it, you treat that $69 like a subscription to a service that's actively rebuilding your financial life. You apply for a car loan at a credit union, not the buy here, pay here lot, an actual lender. They come back at 17.1% APR. It's painful, but on a $13,000 car over 60 months, total interest is $6,300. Still high, but it's $3,500 less than the lot would have charged you. Apartments that don't pull credit exist. They're not always in the neighborhoods you'd choose. You take one. It works for now. The cruelest thing about 500 to 579 is this: you're doing everything right, and the rewards are microscopic. A $250 limit, a $69 fee, an 8-point score increase after months of perfect behavior. But the trajectory exists now, and trajectory is everything. Your score is 604. The system is starting to notice you. Your secured card issuer upgrades your account and returns your deposit. The first time the system gave something back, you feel it. It's a $200 refund, but it means something bigger. You're moving in the right direction and the data is catching up. FHA loans become available at this score. You look into buying a home. The lender quotes you 7.6% on a 30-year fixed mortgage. On a $210,000 home, that's $1,491 a month in principal and interest, plus $105 a month in PMI until you build enough equity. Over 30 years, you'll pay $327,000 in interest on a $210,000 loan. You write that number down. You stare at it. Then you decide to wait. Your car refinance at a credit union comes in at 12.9%, down from 17, not where you want it. But the payment drops $31 a month. At 580 to 619, the math is visibly moving. Every 15 points is a different conversation with a lender. You can feel the architecture of the system starting to tilt, just slightly, in your direction. Your score is 638. You did one thing 2 months ago that changed everything. You called your credit card company and asked for a limit increase. They bumped you from $500 to $1,300. You didn't spend a single dollar more. Your utilization dropped from 38% to 14%. Your score jumped 11 points in one statement cycle from a 5-minute phone call. The mortgage lender requotes you 6.7% now on $220,000. That's $1,421 a month, $70 less than you were quoted 90 days ago. Not because anything in your life changed, because the number moved. You apply for a car loan, 7.9% APR, on $19,000 over 60 months, total interest is $4,080. Compare that to $9,840 at $410. Same salary, same person. $5,760 less in interest, just gone. Because of the score, the landlord runs your credit. You pass, standard deposit, no double payment, no special conditions. You're just a regular applicant now. That sentence matters more than it sounds. At 620 to 659, you're approved for almost everything, but you're not preferred for anything. You're one tier below the best rates. That gap costs you real money every month, not because of anything you did wrong, but because you haven't crossed the next threshold yet. Let's stop here for a second. A lot of people in the 620 to 659 range feel like they've arrived. The cards are working, the loans are getting approved, life feels easier, and it is easier. But easier isn't the same as optimal. The difference between 638 and 720 on a 30-year mortgage is often $50,000 to $90,000 in total interest paid. That's a car, that's a college education, that's a decade of retirement contributions. The score keeps mattering long after it stops feeling urgent. Your score is 677, 2 years of on-time payments, 3 open accounts, no collections. Your credit file looks clean to everyone who reads it. You refinance your car loan from 7.9% down to 5.8%. That's $19 less a month. Over the remaining 40 months, you get $760 back. From a phone call and a credit application, you get approved for a Chase Freedom card, 5% rotating categories, 0 annual fee. You put your groceries and gas on it, pay it off monthly, and earn $340 in cash back over the year on spending you were already doing. You qualify for a conventional mortgage now, not just FHA. Rate, 6.1%, 10% down. Monthly principal and interest on $230,000 comes to $1,396. PMI is still there, $88 a month, but shrinking as you build equity. Here's the honest reality of 660 to 699. Your record is spotless, your payments are perfect, and you're still paying a premium on the mortgage, on the car loan, on insurance, simply because you're one tier below preferred. $75 a month here, $60 there, it adds up to $1,600 a year. You're paying for a number, not a behavior. Push 23 more points and it disappears. Your score is 714. You didn't do anything dramatic. You kept paying, kept utilization under 12%. Let time do the quiet work it does. Pre-approval offers started showing up in your inbox, real ones. Cards with sign-up bonuses worth $500. 0 APR intro offers for 18 months. You didn't apply for any of them. They came to you. Your mortgage lender quotes 5.1%. On $250,000, that's $1,358 a month. Compare that to the 7.6% quote you got at 604. That's $133 less every month. $1,596 a year, $47,880 over 30 years. Saved, not earned, saved, by moving 110 points. You finance a $27,000 car at 5.2% over 60 months. Total interest, $3,740. At 410, the interest alone on a $14,500 car was $9,840. Better car, lower interest, same person, just with a different number attached to their name. Your insurance company repulls your credit at renewal. Your premium drops $58 a month without a single conversation. You didn't ask. The system noticed, at 700 to 739, the bleeding stops. Every penalty, every surcharge, every "you qualify but not for our best rate," it fades. You now get the rate on the landing page, the actual advertised rate, not the footnote. You're not elite yet, but the penalty for your past is gone. Your score is 768. Lenders use a word for you now: preferred. You apply for the Chase Sapphire Preferred. Approved. 60,000 bonus points, 3 times points on dining, 2 times on travel, 0 foreign transaction fees. The card pays you to use it on spending you were already doing. Your mortgage locks in at 4.8%. On a $300,000 home, that's $1,573 a month in principal and interest. No PMI. At 547, the same mortgage would have run you over $2,000 a month. At 768, it's $1,573. Same house, same bank, $427 less every month. Because the number is different. A personal line of credit opens at your bank. $30,000 at 9.4%. Unsecured. You didn't apply, they offered. The option exists now. You don't need it. The fact that it's there means you probably never will. Your rewards cards earn you $1,340 this year on spending you'd have made anyway. At 410, the same spending cost you fees. At 740 to 799, money works differently. The system that once extracted from you now competes for your business. You choose the best rate. You don't accept the only available one. Your score is 831. Oldest account, 12 years. 7 open accounts. Utilization, 3%. Not one payment ever 30 days late. The file is immaculate. There is nothing to penalize. Your mortgage lender calls, you didn't call them, to offer a proactive rate reduction from 4.8% to 4.3%. $83 less a month. You didn't shop. You didn't threaten to leave. The score did the work. You're approved for the American Express Platinum before you finish the application. $8,000 in first-year value between welcome points, travel credits, and lounge access. The $695 annual fee nets, out positive in year 1. The card pays you to hold it. You walk into a car dealership with a pre-approval from your credit union at 3.6%. You hand the dealer the letter before the test drive. The negotiation is different now. He knows you're not financing through him. The price drops $1,400 before you say a word. The score gave you that leverage. You didn't have to earn it twice. At 300, you paid $9,840 in interest on a $14,500 car. At 831, you pay $2,900 in interest on a $36,000 car. At 410, you handed over $2,150 before sleeping one night in your apartment. At 831, the landlord waives the deposit and thanks you for applying. From a $250 secured card with your own money backing it, to an instant Amex Platinum approval. At 800 to 850, the system has exhausted its list of things to charge you for. Every fee, every premium, every surcharge for risk you no longer represent, gone. Your credit score doesn't know your story. It doesn't know that the collection account was a billing error. It doesn't know you worked 2 jobs. It doesn't know any of it. It tracks one thing, mechanically, without opinion. Did the payment arrive on time? And it uses that one data point to price your rent, your car, your mortgage, your insurance, every month for decades. But here's what's true on the other side of all of this. The path from 410 to 760 isn't complicated. It's just slow. Pay on time, every time. Keep your balances below 10% of your available limit. Don't close your oldest accounts. Don't apply for 5 new cards in 6 months. That's the full playbook. No secrets, no hacks. People rebuild from 400s to 750s in 5 to 6 years. Not because they found a shortcut, because they stayed consistent long enough for the clock to work in their favor. Your score is just a number. But that number decides whether your money works for you, or gets quietly extracted from you every single month. And if this gave you a clearer picture of where you stand, drop your current score range in the comments. Let's see where everyone's starting from.